I'm going to go ahead and we're going to have Darryl today, and he's going to be reviewing with us a couple of things that we go through. He did want to just kind of do a quick run through on how he reviews the 1003 application as an underwriter. Again, I do apologize. We ran a couple minutes late. We had technical difficulties on our computer over here. It just would not show us the screen. So I had to restart everything. And we're also going to do a quick bank statement analysis. As he's going to mention, we don't expect you guys to do a full underwrite on files, but we do want you guys to do, to have like one of his sayings that we love, his inspect to expect, right? To make sure that you guys are actually reviewing stuff to make sure that you don't have any issues come up when we do go in and analyze.
Okay, that's right.
What we want is, again, to just basically that you guys, anything that may come up that may become an issue on your loan. We are going to use a dummy file. Just again, he wanted to do a underwriting review with underwriting visualization on the way he looks at a 1003, as well as our bank statement analysis. So I'm going to go ahead and give it to Darryl, and let's get this box to take it away.
Okay. Good morning, everyone. Good to be back with you guys. I know that I believe we had spoken on 1003s before, but I just want to do a recap because, inevitably it does come up again when when reviewing the 1003. And this is the screens in Encompass, of course, but, of course, you guys load it into Encompass based on the application that you take from the borrower. One of the things that I do want to say before we really get started with this, and Hayel had mentioned one of my favorite sayings, which is inspect what you expect. When you're speaking with the borrower, of course you always ask key questions, but when it comes to the debts that are paid or the debts that the borrowers have, if they have a debt that is with the company, say they're, buying furniture with in-store financing or something like that, and that company does not report to the credit, credit agencies. Those payments to that account usually, if not always, show up on the bank statements. And what happens is that if you have reoccurring payments on the bank statement that's not specifically to a credit card, a Wells Fargo, Bank of America, or something like that, that you can attribute to a credit card, then it could very well be that from a unreported liability. Well, we do have to add those liabilities to the debt ratio, and that has caused issues. So I wanted to get that out first so that can be marinating while we go through this 1003. Now, it's going to be pretty quick. I just want to point out a couple of the key things. The first thing on this, when you see that the permanent resident alien box is checked, which is very normal. A lot of our clients are permanent resident aliens, or maybe even be non-permanent resident aliens. Anytime that there's anything other than a U.S. citizen, you want to go ahead and ask for residency docs. Just do it across the board, regardless of whether, that they say, well, I've been a permanent resident alien for 30 years. That doesn't matter, because our agencies, especially the government agencies, FHA, VA, and what have you, well, I'll just say FHA more than anything, they're going to want proof of residency, as do a lot of our investors. So any time that you have a permanent resident alien, anyone that's on any type of visas, whether it's the borrower, co-borrower, it doesn't matter. You want to go ahead and secure those residency docs. If you have a single borrower, and this is kind of gender influenced, but for instance, if you have a male borrower, unmarried, and it does have dependents, then you want to make sure, if it's unmarried, you want to ask that child support question. Or you also, if there's dependents, you want to ask, was there any divorce in the history? Now, it doesn't mean just because they have dependents that they have to be married or they have to be paying child support, but that could very well pop up in further documentation, like pay stubs and what have you, where there's any type of deductions or anything like that. So as a trigger, when you have dependents, go ahead and ask that question. It's going to be very, very helpful. Right here, when it goes down to where the housing expenses are, when there is no primary housing expense, which is common, automatically know that we're going to need some sort of LOE or something from that homeowner who they're living with, saying that they live rent-free. So anytime you have one that's no primary housing expense, automatically know that you're going to need to have some sort of explanation of who they're living with and how they are living rent-free. Now, a lot of times we'll have, two borrowers, they could be engaged, they were living with parents or whatever. But, primarily, if you have both borrowers with no primary housing expense, that flag is going to get bright red as opposed to just a normal red. Because again, with no primary housing expense, it affects everything from payment shock to affordability, especially if they're buying a multi-unit property. If they've had no primary housing expense and no history of paying rent, we cannot give them income that's generated from that income producing property. So keep that in mind as well when using, when completing this. So if they are purchasing a 2 to 4 family house and you need that income, you need to show that they are paying rent. That's across the board with every agency and what have you. If they're going into an investment property, they have to show history of paying before. I'm always looking at how long at the current address. You got to keep in mind we're always looking for 2 years. So if they've only been here for 1 year, make sure you put the former address in here so that we have a total of at least 2 years. Okay, so that's the key thing on IRLA 1. Of course, military service. This is important on VA loans, but it's a good thing to ask your potential borrower if in fact they do have any type of military background, because obviously VA loans are more borrower centric than your normal FHA or conventional loan. Okay, now going to IRLA 2, the second page. Obviously, this is your income and all of that. Keeping in mind that we're always looking for the amount, looking for a work history. So if this start date is within the last 2 years, you got to know that you're gonna want to show where they worked at previously, and that's a little bit further down the page. Now, this is key, and because this changes things as well in income calculation. If they are working by chance for a family member, make sure you're asking those questions, because that is very, very important. This is self-explanatory. If they're self-employed, you want to do that. As far as the income goes, you definitely want to make sure that if they are self-employed, find out what the percentage of ownership is, because if it's less than 25%, we can easily go pay stubs and W-2s. But if it's more than, you got to know that you're going to need your self-employment documentation. Depending on whether you're going, if it's conventional, you're going LP or DU. LP typically is 1 year. DU is always going to be, not always, but 99% of the time, it's going to be 2 years. So keeping that in the back of your head, if in fact you have not determined which GSE you're going with as far as goes with Fannie or Freddie. Going down here, if there is addition, they have 2 jobs and whatnot, to fill that out. It's the same situation here with the income. But this section right here, where it says, previous employment, if we do not have 2 years on the current job, you want to make sure that you have this part completed, so that it will it will give you that 2-year work history. And opening the box, show all VOEs, this is where you itemize each job. So it might, they could have had 5 or 6 different jobs, 6 months apiece or whatever the case may be. You just want to make sure that you're thorough in putting the information in here, because this converts over to this as well. Any additional income, depending on the type of it, you got to know there's going to be need of supporting information. If in this case, in this sample, we have I'm sorry, I didn't want to change that. We had capital gains. Then, I encourage you, if it is conventional or if it's going government, to pop in. You can even Google capital gains income for Fannie Mae, capital gains income for FHA, and it's going to tell you exactly what you're going to need. But this is where that income goes. When I say inspect what you expect, I really mean to try to anticipate what I'm going to ask for, or what, if not me, what any underwriter is going to ask for. It only helps you going forward. All right, and this is where all your totals are, of course. Now, on this page with the assets, one thing to keep in mind is that if ever you're using retirement funds for reserves and not, if this was a refinance over 45% debt ratio, you're going to have reserves, you have retirement funds, and the statement says they have $100,000, you automatically know that it's 60% of that, so it's $60,000. So anytime you're using retirement funds for those things, automatically hit it by 60%. Conversely, if a portion of the retirement funds is being used to consummate the purchase, then after you deduct the amount of the base retirement fund account for what you're using for the purchase, you got to hit that balance by 60%, which is what's going to identify what can be used for reserves. So retirement funds and whatnot, that's the real thing that fluctuates between the two. All right, now in looking at this drop down, a lot of these different things, they do require additional information, of course, stocks and stuff like that. You're gonna have to have those statements. So if you have other than conventional checking or savings account, make sure that at the very least, if you don't contact the scenario desk, just Google it. And it'll give you a general framework of what's going to be needed in those situations. Now, of course, you can always email, like I said, email the scenario desk or email me, and I will definitely do whatever I can to help load your guns on that. Additional assets, anytime this is pretty obvious, they're selling a house and agree to purchase this home, you want to put, put in what the anticipated amount of proceeds you're going to get. That's going to filter over into everything you need. All your credit, this is going to be imported from your credit report. And keep in mind what I said initially, if there is something on the bank statement, or you're asking that borrower if they have any accounts that's not reporting on credit, this is where it will be manually put in, and it has to be in here in order for it to calculate in the debt ratio. So if it does show up and you didn't do it, and then I myself or one of the underwriters does find that and input it, obviously it's going to affect your debt ratio. So I would do my best to try to stay on top of that and anticipate. If there is child support, this is where it goes. If they're making child support payments or whatnot, of course, this is going to adversely affect the debt ratio, because this isn't where the income goes. This is where if they're paying child support, they're paying, different alimony or any type of maintenance that's court ordered or anything like that. This is where it's going to go. So make sure, again, that you put it in there, because if you miss it, not put it in, it's going to mess, it's going to derail what you had already quoted with the borrower. I'm looking at here, when it comes to any REOs that they may own, they'll say that they were going to convert their primary into an investment property. This is where that information goes. Okay, now what I look at in this screen is I'm going in and not only looking at the address and all of that and what we're associating this property, what it's going to be going to. I want to make sure that, any lien that's on credit is going to show up here. I'm going to attach it to it. I want to make sure if the status of the property, in this case, they're going to be selling it, PS pending sale. This is, these items, all of this is important in the underwriting decision, because I have to incorporate it, because if it's not pending sale, then it's going in the debt ratio, whether less the anticipated rent or whatever the the influence it will still have on the debt ratio. Keep in mind, now when it comes to rent, I'm not going off topic, but if they are vacating their primary and they're converting that to a rental property, just because they say on the lease that they're getting $5,000 a month, just because they say it, it's got to be supported. So really and truly, a lot of the agencies are going, especially investors, they're requiring a 1007, which is a rent and a market rent for that property. So keep in mind that, you know, just because you say, well, I'm gonna get 5,000, and then you work up your numbers based on 5,000, that amount that they state has to be supported. Because again, this is one that they're turning into an investment property. It's not one that will have historical rent where, you know, you can show bank statements or it's on a Schedule E. So just keep in mind that if you are converting your primary into an investment property, whatever your rental income you're claiming, you're going to have to support that in some kind of way. All right, so again, that's the only thing left on that. Now, this is a very important screen. This is your you know, screen 4, and I'm trying to, we used to call it details of transaction. A lot of stuff is on the early report screen that was on the details of transaction. This, okay. So on this particular one, you can see loan property information. This is where, you know, the house that we're trying to buy. This is, you know, the type of loan it's going to be, that, you know, that this is if in fact they're going to be, you're going to get a down payment assistance loan or anything like that. That's all going to show here. But one of the key elements that's going to show here, obviously, is any gifts that you may give, you may be receiving, or the borrower may be receiving, I should say. The source of that gift, this tells you who the approved sources are. I want to tell you, with this being a Fannie Mae, an FHA example, if that borrower is a relative, you have to show a direct connection. Now, ironically, I could, if my fiance was giving me a gift, that's not acceptable. It would have to come from a close family friend. You know, that's the correlation. Now you may say, well, it's my fiance, of course she's my friend, or he's my friend, depending on you know, whatever, you know, going on there. But the fact is that, you know, a fiance is not a viable or an acceptable source of a gift on an FHA loan. Now, you know, I've used Google references a couple of times. If in doubt, you say acceptable gift. Can my fiance gift me? You can ask Google a lot of these questions. The Google should be paying me for this, but you can ask them a lot of these questions just to help you out. Or again, you can always reach out to Scenario or even email me. But all gift sources, you know, are not acceptable. So you just want to do a little bit of diligence there for that. This section, very important. They're going to occupy it. If this is a no, then and everything else shows on occupied, it's going to cause errors on your DU or LP. Absolutely. If they've owned it, now this says they're going to occupy it. In this case, have you had another one in the last 3 years? This says no, and it obviously should be yes, because we're pending sale. So you would make sure that this is corrected to yes, and then it'll ask you what type of it is. Obviously, it was my primary. I was joint with spouse, or in this case, going back with sole ownership, because this is an individual example. Okay, now the rest of these, obviously, you know, you want to click yes or no as they do apply. I'm going to scroll all the way down, and this is a couple that have caused, you know, residual issues before, is if in fact that borrower has a foreclosure in their history. A lot of times borrowers they'll say, no, I've never had a foreclosure, when in fact they have. So just make sure you're asking that question, because a foreclosure search is going to be done. I mean, when we do our fraud report, it's going to show any foreclosures that's been associated with that borrower or that property. But also investors and agencies, they run the LexisNexis on it prior to purchase. So even if I don't see it, or you don't, or the borrower doesn't mention it, it's definitely going to come up. Okay. So just make sure again, it doesn't disqualify. So it's one of it, but it will hamper or slow it down, or it might change the amount that they qualify for. And I would rather know that up front than I get to the finish line thinking I got apples when I got oranges. All right. Same with bankruptcies. It says 7 years. I mean, even though the look back is less than 7 years in a lot of cases, if there is a previous bankruptcy, it's not necessarily just do they qualify after the bankruptcy, it's their post-bankruptcy derogatories that become a part of the underwriting decision. So, and this typically will show up on credit. Foreclosure may not. Bankruptcies typically show up on credit, but a lot of times you're taking these applications before you run credit. If you go ahead and ask that, then you're going to know upfront or as soon as possible. So we want to go ahead and ask that up front. This part right here, I don't really get into too much because this is the HMDA information you do when you take your application. Now, this is where everything comes. This is where everything really hits the rubber hits the road. Really is on your early lender screen because this summarizes everything. This is the old page 4 of the 1003 before we went to the early world. And this has all your details of transactions. Now, in doing this, obviously you guys know how to take applications, but so you automatically know how to complete this. But I just want to reiterate that all of this is very, very important. If it's in a PUD, if it is a condo, if it's not located in a project, which is, a normal, when I say normal, it's a house, it's not in a PUD, it's not in a project. You want to make sure of that. Right here, this is if they were buying a 2 to 4 family, then this is where that rent would be. They're buying that 2 to 4 family. Gross rent, I was saying, is $5,000. Then the occupancy rate obviously is going to be 75%. So that's going to give them additional income. And you saw my debt ratio change. But keep in mind what I said before. If they are purchasing a 2 to 4 family, they don't have a history of paying any housing expenses, you can't use that income. You cannot use that income if in fact they have no history of renting. So take that out, and then my debt ratio goes back out of tolerance based on this example. So that's a key thing to keep in mind. This information here when it comes to the purpose of the refi and all of that, of course, this is important, but this isn't going to change the underwriting decision. This is just something that, that's just the details of the transaction. Okay, so this part is important. Obviously, fee simple or leasehold, that has residual connotations throughout. If it's leasehold, then you got to get a copy of the 99-year lease, and then the leasehold payment has to work into the debt ratio. But if it's a manufactured home, now the lenders won't do them if they don't own the land as well. And that is what leasehold means, because if they don't own the land, then that mobile manufactured is still a car, because it can be moved from another site, from site to site. So fee simple and leasehold, it does have its importance. I would say 90%, if not 95% of the loans that we see are always going to be fee simple, but it is important to ask that or to try to ascertain that at application. All right, so I'm moving down. Obviously, this is the information that's, just a general makeup of the loan, where you have your purchase price, loan amounts, and all of that. This is where your monthly payment that's used to factor in the debt ratio goes. Here is, and here's the rest of the monthly payment. Obviously, this is just the principal and interest portion. Here is where everything is broken down, where you have your insurance and all the other, things that go into it, whether they're paying MI or PMI, the property taxes, and all of that goes into here. So here's the actual monthly housing expense here, and that's the part that does affect. That's used in the calculation of your back end DTI. All right. So, and moving through here, this is, while it looks, a bit daunting, this is just the common information. Breaks it. A lot of this fills out from the other information you put up up top. But what I'm looking at is I'm looking at seller credits. I'm looking to see what my down payment is going to be, cash deposit. I'm looking to see and this is where my EMD, because once I see it on here, automatically make a note to say I need to verify funds for that EMD. If there's a seller concession, if it's a seller credit, then I'm looking for the contract to see that the amount that we're saying that they're getting is on the contract, or addendum, because those are usually negotiated. But if you have those, just know that you've got to be able to validate that. And then the rest is pretty self-explanatory. Here's the net amount. In this case, you only have to bring a quarter to the closing, which is a beautiful thing. I've never seen it, but dollars cut this out of pocket, they only come out with a quarter. I went through this pretty quickly because I know all of you guys have seen 1003s a million times, but there's a couple of key things in there that I want to make sure that you're cognizant of, and that's the residency, that's the trigger with dependents, where that could raise questions. It's all then it's your primary housing expense. If they're purchasing income producing property, they've got to have shown that they paid rent or mortgage payments before. And then also when it comes to your assets, if you have retirement assets, know that it's 60% of that is what's used for reserves, or the net after they've extracted from their retirement account for cash to close. That net, only 60% of that net can be used for reserves as well. So, and reserves are very, very important. In a lot of cases, even though a loan doesn't call for reserves, it's always used as a compensating factor if other risks are evident on the file. So compensating factors, not just reserves, but also say you got two borrowers and the borrower gets paid overtime, but we're not using the overtime. That additional income that we're not using for the calculations is a compensating factor. So I would, as an underwriter, I'm going to state that on the transmittal so that it would see that that has been used as a part to mitigate maybe something else risky on the file, a previous bankruptcy, a previous foreclosure, or something like that. I want as many compensating factors as possible. So don't think in terms of getting the least amount of information. Think of getting as much information as possible, because a lot of this is used in the underwriting decision and not just the underwriting calculation. So that's a key takeaway from that. Now, as far as the 1003 goes, can you unmute it? See if I'll get ready to unmute it. I know I went through that pretty quickly, but I want to see, does anyone have any?
Well, they can unmute.
Okay, if you have any questions, just unmute and let me know if you have any questions.
Don't be afraid, guys. Remember, Darryl is here to help us. So we're loving that he's so willing to come in and do these classes with us. He is going to also get into discussing this section here of the IRLA, which a lot of us kind of tend to skip through and we just always put no. So please unmute if you have any questions on regards to how he views the IRLA as an underwriter. And then we're going to get into the next portion of this, which was the asset review.
Absolutely. Okay, 5, 4, 3, 2. Okay, so
you missed your chance.
now this part right here that she went back to, very, very important. Have you or will you be applying for any new credit? Again, a lot of times things will not show up on the initial credit that's ran. Now, what'll happen here is it'll show up when we run, because before closing, we run a credit refresh, or for people with investment properties, we run a credit supplement. But that's going to show any new credit. And I know that as a loan officer, because I've been a loan officer for a long time as well. As a loan officer, ain't nothing worse than you get to the finish line, you run your credit refresh, and then they opened up a Best Buy account, or they traded in a car and got a new car, or something like that. So by asking this question with them when going through your 1003, then you're gonna get those those wheels running in their brain saying, oh, I should probably say something about it. Because I know that when I originated, one thing I always told my clients was, please don't open up any new credit while we're in the process of this loan. And I know you guys say that all the time, but what has happened is, okay, I'll say don't open no new credit when they had already done it right before the application. And of course, it hasn't cycled on their credit report. And they think that they're, when I say they think that, I don't mean that the borrowers are being shady, but in their mind, they may have forgotten, or they might think, oh, it's not going to matter. I haven't charged up anything, or my first payment isn't due yet. But all of that does factor in there. Okay, so just make sure that you do, spend just a little bit of time in asking these key questions from this part 4 part, because I'm telling you, I've had loans derailed because of that. I've had loans derailed because of that. Because, again, the borrowers may not realize that is a factor, but it always is.
Then we have some samples. Right there.
Okay, so what we also have here is I gave her a bank statement. Now on this bank statement, it's a couple of things that's on here that's all that speaks to what I spoke about a minute ago about non-disclosed debt.
So basically what you wanted.
All right, so you see, she made it look sexy. I was going to. All right, so this is it. When receiving a borrower's bank statement, you want to look for reoccurring or ACH payments, large deposits, IRS payments, or bank transfers. Break it down in plain English. Reoccurring or ACH payments is, you buy something new and it's auto deducted, automatic auto clearinghouse payments. That's what your ACH payments are. Large deposits, depending on the agency, they have. Now, sometimes your DU will tell you exactly, I'd say your AUS, because it could be LP. It'll tell you exactly what would be considered a large payment. But anytime there's something that's 50% of what their normal monthly income or their normal deposits are, considering we're getting more than one bank statement, then that's considered a large deposit. Or if it's more than what if their payroll is deposited, if it's just something like a large Zelle payment or something like that that's just large, you want to identify it. Of course, IRS payments, and we'll see an example of it. If they're making payments to the IRS, then not obviously, but 9 times out of 10, they have a payment arrangement for an IRS debt. And as we both all know, that has to go in a debt ratio. Bank transfers, that's very important because, we've had where a borrower has, say in this case, a borrower has, he has a beginning balance of 37,000. Of that 14,000, say 10,000 was a transfer from savings. All we have is a checking account statements. We need to have that source, the statement from that source account. That is something that FHA is calling for on every loan, and we're also getting that from our other investors. So anytime in a bank statement that there is a transfer from an internal account, you're going to need to show that account. So I suggest you scrub it to make sure that the source account doesn't have create any other flags, but I'm here to tell you it's going to be necessary. So that's the bank transfer part of it. This is a snippet from that bank statement, and this will show you. Now, the card purchases, these are normally customary things, okay? Utilities, water, coffee, delivery. These are elective types of things. So it's not going to really raise a lot of flags, but on the actual statement.
Yeah, so these were low level importance because we have been asked if we hit people with these. So we wanted to kind of just point out that it's not something that, even if it's a reoccurring, it's obviously a living expense and not an actual revolving expense like a credit card or something like that. One of Darryl's favorites is, say it, what's your favorite?
Which one, the inspect?
No, the creditor that does not show up on the credit report, but you don't know how to pronounce.
I'm not gonna say it, but
Come on, say
they're
it.
making fun of me because I think That's my new one.
Wanted to hear.
I don't know which one it is.
Curaçao.
Oh, yeah, yeah. Carousel. Yeah, that one. See,
He's not talking about the drink, he's talking about Curaçao.
yeah, they do. Yeah, she was laughing at me earlier at that. So what happens is, they buy buying furniture from them or whatnot. They have their in-house credit. It doesn't report on the credit report, but it shows the deductions on the bank statement. And those payments have to be factored in the debt ratio. So that's one thing. And that happened. I was trying to see if it was on this particular account, but it was, that definitely has happened on a lot of these. Here it is right here. You see this? This wasn't disclosed, but it's a tax payment. That $500, 9 times out of 10, that's a $500 a month debt that has to go in the debt ratio. Now, the borrower didn't, through the normal course of originating this loan, the loan officer didn't pick this up. They didn't say that to us. But when it got to us and I saw that, I had to input it in and it derailed the loan for a bit. They had to bring in a co-borrower. So that's the part. This one, okay, you see the co-part, that's his employer. That's the payroll. They got $2,100 is each pay period. Well, unless, say it's 2 pay periods, so that's $4,200, say $4,300. My deposit is $14,000. So you got to know that those large deposits, if they're incremental, then you don't have to worry about it as much. But if you have some large deposits, then that's going to be a trigger. And here's one right here. See this transfer from checking, if we don't have that account, that transfer, we need to have that source account.
And as you can see, you guys, is that what Darryl was mentioning here is you have several transfers from 2 different banks. You have one transfer here from, and it'll tell you, it's a checking ending in 1625. And you have another one that are transfers to, for 3650. So whether it's a transfer in or a transfer out, like Darryl was mentioning, it's stuff that we're gonna get called on, which is why we wanted to show this one who had tons of transfers. And of course, again, the IRS payment. But you guys want to be looking out for all that stuff. Another thing that I know we've sometimes get called out for are Zelle payments. If you see a reoccurring, and it's going to that same person, again, it could be, maybe they're paying off a loan, a personal loan. So I know that you kind of had that, right? So Manuel did have a question.
The key to that, Manuel, is if in fact it's voluntary advance, that's fine. What I was saying is I don't necessarily have to include it in the debt ratio. In this case, I did, but if it is an advance payment, you can document that. Absolutely, that doesn't go in the debt ratio. So it's all, and what you just said, that's inspecting what you expect. In a case like that, you absolutely, you have the documentation to support that is an advance payment. I'm not looking to add anything to the debt ratio that I don't have to. But if it is something that very well could be, then we're going to have to address it. And a lot of this is just, is addressed with, infamous LOEs. Okay, this is it right here. I was looking everywhere for it. This is on this particular loan, this right here.
My bad, guys, I forgot to highlight it.
This right here, this elastic payment, it's not on the credit report. Okay, so, and that payment was on the 2 bank statements that we provided. So that payment, that $281 also had to go into the debt ratio. So we had to put in an additional $781 a month for this borrower. And that threw the ratios way out. So we had to restructure and bring in another borrower. That was it, elastic. I was thinking it was the Curacao, how you say it?
Curaçao.
Yeah, whatever, that one. I thought it was that.
He wants a drink.
I do, that is a drink. I don't even like fruity drinks. This sounds fruity. Okay.
But what what Darryl was mentioning is, like you see here, there's another one that says paseos. A lot of the times us as LOs, we kind of just sort of look at the withdrawals and all that good stuff. If you ever see a car payment, they don't have a car payment on their credit report, guess what? If it's reoccurring on their bank statement, we're going to have to hit him with that payment.
Or address it.
Anything like that one that was $281, because we already have two bank statements showing that debit. And again, you notice that this is an ACH payment. This is not something that he made himself. And you can tell by where it says payment, it has all those numbers, web ID, all that. That's an ACH payment. That means it's automatically being deducted from their bank account. And it becomes a reoccurring debt. And again, it's not disclosed on their credit report, but because it is on there, like Darryl said, we have to hit him with the payment or address it. In this case, what would you ask for if we wanted to exclude it, Darryl, if this was like a bank statement with two different people on it?
Okay, so if we would want actually the loan agreement, that elastic payment was for, it was for some kind of goods. What ended up happening on this was the investor had Googled Elastic to make sure that it was, you know, I'd say
Like
a creditor, and found out. So we had to ask the borrower what it was for, and then we found out. I know that I was saying furniture with the Curacao, whatever, but this was actually, its elastic payment was for furniture on this particular one. I remember it because it gave me fits.
Yeah. So Anna, for your question, there are certain creditors, or like what he was saying, Curacao, there's certain companies that don't actually report to your credit report. In this case, this was one of them, Elastic Payment. It was a furniture store that did auto withdraw from their account, which again was something that was not disclosed on the initial loan application, but ended up hindering the transaction. I know in this case, Darryl asked for obviously the statement, and the statement did have the borrower on there. So, and not the bank statement, the statement of the account for Elastic. And this is where we realize, and here we see on 114, the payment came up again, which is how we knew it was a reoccurring payment that was being withdrawn from their account. So it was a furniture store that that was not reporting on their credit report, but was reporting on their bank statement, which in fact ended up affecting our debt ratio.
Here it is again. This was, you know, where they ended up getting some sort of refund back from it or whatever. But really, it was, you know, when combing through this, it's looking for the same, you know, the same payee. Anytime you have a payee more than once, that's a trigger. But if there's a payee and then you have similar or the same amounts every month, then that's a trigger as well. So on this particular account, it was two things that popped up that affected, that obviously is not on the debt rate, not on the credit report, is that's this tax payment and the ones to Elastic. So, and those two things showed up. So this is just an example. And I know, you know, you guys scrutinizing the bank statements and whatnot, it's really something that y'all
I have a question.
Who's it?
Hi, it's Anna. So on this Elastic payment, I noticed that there's two different amounts. This first one was 281 and the second one was a little higher.
Mm-hmm.
So what are we supposed to hit them with?
Well, in this case, it's the loan agreement. So what happens in a case like this, you know, what FHA required us to do is hit them with the highest, to be honest with you, on this example. But what we could get is we can get their statement, just like if you were paying off a credit report, paying off a credit card, and that on their last credit report, it said the balance was $2,000 and a payment of $150. But you give me a statement that shows the balance is $1,000, then I'm going to pay off the $1,000. So what we hit them for is we get a recent pay, we get the most recent statement. You know, that's the main thing that we will be looking for. So if that recent statement, unfortunately, that recent statement said the payment was $400, that's what we would have to hit them with. The key here is that if you have recurring debt to a potential creditor, you have to get the most recent statement. So that's the trigger that you would, as a loan officer, ask if you did review the the bank statement and you saw recurring payments and they're not the same amount. Because if they're the same amount, 9 times out of 10, it's an installment. But if it's, if it is some sort of revolving or interest-bearing account, it could fluctuate. So in this case, we would get the most recent statement, and then that's what they would hit with. Or that now, conversely, that recent statement just shows paid off, and then all is moot.
Yeah.
So what we would hit them with was whatever the most recent statement would be. That's why I kind of alluded back away from the payment to the creditor, because that's what you're, that's the trigger. That's what, what made this pop out was the payments to Elastic. But, that more so than the account, because with it being revolving in nature, that payment fluctuates.
And also one thing, I know this is gonna sound really funny, but we had this actually in one where we had a Zelle payment. And as we can tell, this guy has like a lot of transactions. He does have Zelle payment. But we did have one where, as a joke, on the notes, he put child support. It was a joke, yes, but unfortunately, guess what? It does become a trigger.
Yeah, so they don't have a sense of humor.
Yeah, underwriters don't have a sense of humor. Yeah, well, Darryl does.
I do. How funny is that? But most underwriters have no sense of humor.
But unfortunately, because they did put child support, and even though it was a joke, and it, we do have to address those things. I didn't bring that sample with us today, but we actually had that happen, where we had that occur where the borrower actually sent a payment to a friend and put child support. So it does become a trigger. So I know a lot of us, try to be funny with stuff like that, but we do want to make sure we're addressing that with our borrowers so that we're addressing it ahead of time to our underwriter. An LOE, hey, this is my friend, we were just joking, whatever, it may work, but I don't know, depending.
Yeah, well, that's, and then if it says child support and all of that, then you'll go back to the earlier page 1, see if they have any dependents and stuff like that. So, it creates another layer of diligence that has to be done if something like that is on there. But as it pertains to Zelle payments and stuff, you also want to see if in fact there's regular payments to an individual. Just, an LOE, I had the one just last week. It was regular Zelle payments to someone with the same last name. So assuming that it was a child or a family member, and asked for an LOE for the consistent Zelle payments, they said, "Oh, I'm just helping my brother out." That's fine, but we have to address it, because if it's not addressed, then speculations and again, it's always going to be worst case scenario when the investor is looking at it. I'm a sucker for a good conversation, but you got to start one. So make sure that if there's anything that you see, go ahead and address it up front, or at least get that ball turning so that it's not going to hinder you as a loan officer when this loan hits the road to closing. So, a lot of times, in going through this now, your operational partner, they're going to go through it. The girls and guys who work here with me, they know we work closely together. They know what I'm looking for. So you may get this same conversation from your operations partner, your processor or whatever. But as a loan officer, I know me, I always inspected everything because I wanted to be able to count my money. So as I'm looking at things, I'm looking at it in detail as to how things can be construed. And, I wear glasses and contacts, so I still miss things, but, I have caught a lot more, and experience being the best teacher. That's why I've learned to do that. So, on this one, he's Zelle payments, and again, it could be anything. I mean, it doesn't really matter, that they're zelling it out, but this Zelle is to Eduardo Quevedo. If there was one every month to him for 80, 200 or whatever, we need to know consistent, continuous Zelle payments to this person is for, you can say a personal loan, which you really don't want to say, but you want to say something like, I'm helping them, or, I'm helping my son with his utility bills, something like that. Like I said, I'm a sucker for a good conversation, but you got to start one. And by looking at it, by inspecting this, you'll be able to do it. But, key takeaways is, this is the IRS thing, and, and the payment to that other company. I can't think of it now. It lasted. Okay, so in summary, as we're coming up on the hour, going through the 1003, just, take time and go through those. I kind of gave you guys some of the triggers for me that trigger for me when calculating your assets. Make sure that if you have, retirement accounts and whatnot, and using that for income, I'm sorry, for cash to close, the net that remains, you got to hit that balance by 60%. If you are using it for cash to close, you got to know that you got to show liquidation and deposit. So that being the case, you're going to be able to show a statement of what the balance is, and whatever that balance is 60%. If your borrower has income that we're not calculating, compensating factors help mitigate risk. Keep that in the back of your mind. So anytime you can throw a comp factor out there on a questionable loan, it can do nothing but help you. It can do nothing but help you. We don't need that for the debt ratio. My debt ratio, the limit is 45. I'm at 44.9, but I have income that I'm not using. Then I'm looking more favorably on the fact that he changes jobs every 6 months. So, again, the compensating factors is very, very important. But, a thorough application, I'm telling you, it increases the probability of the successful and painful closing. I always tell you guys, if you have any questions, feel free to, if you don't want to speak out in public now, shoot me an email, or you can call me or IM me or whatever the case may be. I'm your underwriting partner. I'm not just the underwriter. I want to close them all, but I do want to make sure that they stay closed, because I use analogies a lot. You guys are dating a loan. I got to marry it. So I got to make sure that this marriage be successful. So nevertheless, does anyone have any questions over all the stuff I'm blabbering about? 5, 4, 3. But no, it's always a pleasure for me to come and chat with you guys. We'll come up with another topic. These are our sessions. I know they're helpful for you because it feels from where I sit, getting this out and being able to trigger something you may or may not have thought about before, it only increases the integrity of the submission. So let's get them in, and if you have questions, get them to me, man. Let's work through it.
So you guys have maybe 1 more minute if you guys want to get on some questions with Darryl. Don't be shy. Well, thank you everybody so much for attending. Again, this was more just to kind of show you guys what Darryl looks for when it comes to assets. I know our slides were not that extensive. It's more just to show you guys what are low level importance and anything that you guys should be looking out for. Of course, not all of these debts and withdrawals are going to be the same, because it can, like Darryl said, it can be Curacao, it could be elastic, it can be anything like that. So if you do see something that's reoccurring, Darryl says it a lot, he should endorse Google, because Google it, see what it is. If it's not showing up in their credit report and it looks like a creditor, definitely make sure you guys are questioning it with your borrowers. And if you guys don't have any questions, thank you so much again, everybody, for attending. On Thursday, we will have another class for foreclosures for any of our realtor partners, as well as our loan officers. If you guys want to invite any of your realtor partners, please feel free to do so. We don't mind sharing our knowledge. And thank you all again. We really appreciate you guys attending. Bye.